Hi, everyone. Thanks for joining us today. I'm Rick Bensignor, and this is In the Know Trader. Today is Tuesday, February 14th, and we've got a brand new show this week. I want to follow up on a subject that we've talked about before, but get more specific to it. And in this case, I'm going to title the trader education portion, How Do You Disregard the Daily Market Noise? This is something all traders need to deal with, and we'll talk a few minutes about that. And then this week, we'll also take a look at one of the best performing sectors so far this year, that's communication services. So we'll take a look at the top 10 names that are the components in that particular sector so that you get a look at what the charts are showing us. Before we go into all those details, let me tell you about what we have at the In the Know Trader website available for subscriptions. First off, we have our weekly ETF Tactical Trader Report that generally comes out on Thursdays, does a very deep dive across all the sectors that affect the U.S. equity market. So when I talk about sectors, really asset classes. So we're talking about the bond market. We'll do a deep dive into the U.S. 10-year and credit spreads, what they're telling us about the market. We'll always take a look at the dollar and usually the gold market. We'll do a deep dive into the S&P itself too, the key levels. And of course, this is the benchmark for almost everybody out there who's in the equity space. So I tell you my thoughts on how to play it, what the direction is, where possible turns are, and the general overall strategy for playing the markets. Again, that comes out Thursdays. I then give you a brand new ETF trading idea each week and also walk you through all open positions we have until we close them out. Secondly, we have another written product called the 7-Eleven report that comes out at the end of each month. The goal of this report is very simple. It's to outperform the S&P 500. And the way we do this is I choose no more than 7 of the 11 Spider Macro ETFs. In other words, XLK, which is information technology, XLP, consumer staples, XLY, consumer discretionary, etc. There are 11 different macro sectors to the market. By being in no more than 7 of them, we're making our bets on which ones will hold up with the S&P, and we generally try to eliminate the 4th that we think will underperform or hurt you for having them included in the general S&P's return. Here's our results since we've started this. First of all, last year we outperformed by over 6%, and in 11 of 12 months. This year we had a tough January, as most portfolio managers did, because the sector rotation was absolutely huge. It's still continuing into this month. So we trailed by 1.96% in January. That is by far our worst month that we've had. But overall, since we started this, we're up over 10% versus the S&P in the 30 months that we've done this. So still very handy returns, well above and beyond what you would get for being in the S&P 500 yourself in some type of passive index fund. In order to continue watching this, the best thing to do is to subscribe to my YouTube channel. Go to youtube.com/InTheKnowTrader and subscribe. And this way, these will be top of page each week. When I do a video, it will become top of page when you log into YouTube. And also follow me on Twitter at InTheKnowTrader.com. So let's go back and talk about this idea here of dealing with the daily noise that happens in the market, and as a trader, how that affects your approach to the market at any given time, and whether or not you have a bigger game plan that can still stay in place even given the daily noise. So when I'm talking to you as you being a trader, I think of it in terms of, we're not talking about day trading, And we're not talking about investing for 6 months to 12 months or longer. We're talking about trading in the short term, which generally is a couple weeks to maybe a couple months, but nothing beyond that. That's what trading is about. If you're buying a stock that's been badly beaten down and you're looking for it to bounce, and you expect this to be a long-term hold, because the market, let's use the example of the market having sold off so much last year, and it certainly presented lots of opportunities. Even in something like Meta, which went from 100 to 200 recently, that may very well still be a trade. Let's say you were fortunate, you got long at, we'll just pick a price. Let's say after the low was made, you got long at 125, and a month later, this is trading at 200. If you do your analysis and you're happy taking that as a profit, it's still within the realm of a trade and a good trade. But it doesn't mean you're holding on to this for Tesla to go back to $500, $700 or whatever per share over the long term. A trade's a trade, and an investment's an investment, and the two should not mix with each other. But how do you deal with the noise that happens when, let's say, your stock rallies to 200, and then 3 days later it's trading 180, and that's a 10% move in just a couple of days. That's a lot of market noise. You've got to have a process in place to be able to handle all the up and down movement in the market or a particular stock, that still keeps you in your idea of the trade, and then also have the confidence that if a particular level breaks that you want to use, in this example, let's say as a sell stop, that if we get beneath that level, it really ups the odds that that stock is going lower, and that getting out at your sell stop's the right thing to do. What you don't want to do is put in a sell stop that ends up getting knocked off, and then 2 days later, stock's right back up near the highs. So, and that's part of getting caught in all the noise. So I'll tell you, it still comes down to having a process. So I'm going to pull up a chart here. Not this one, but let's take a look at something like, here's the Russell 2000 through its ETF. So this is IWM, the Russell 2000 ETF, very liquid, very highly traded, the easiest way to get exposure to small cap stocks as a single index. And you can see, let's look at, let me highlight a section here. So let's go to, let's say, this area in here. So in October, we see a slightly lower low than September's low, and the same day it does that, it turns around and makes a very significant rally, and that starts this up move, and we get a pullback and a double bottom, and then we extend to new highs. And certainly one could look at this and even get some sense of, here, let's say if I took even something like this, we get a sense there's an uptrend here. But now your uptrend line breaks, and you've taken out, let's say, these three lows over a half a month period. Very easy to stop yourself out here and saying that's all, double top, we just took out the double bottom, we're going to come lower. And there's even an unfilled gap to deal with, so we're certainly going to fill the gap. And you knock yourself out into this zone. So let me put up, for instance, so somewhere, let's say in here is where you've stopped yourself out, only to see it, gap well higher, but then trade down that day. And this is what we're talking about, lots of market noise. Then this sells off, and you go, all right, well, we're probably testing the lows, but then it consolidates here in December, and then starts a whole new leg higher, breaks back above that level, comes back to test it, and so on, and now we're up and even above, the breakout level what do we do? How do you deal with, a strong move up that all of a sudden then right in here gives essentially it right back, right? So from this 3-day open candles, open near the low, closed near the high. This one here, open somewhat near the low, closed somewhat near the high, but not as strong. And then you do it again. You say, wow, this thing's lifting off. We're going to take out the highs. And boom, you spend the next week and a half selling off. To me, it all comes down to process, and do you have tools and ways of approaching the market such that you can kind of define what's going on and yet also have a sense that what you're doing is correct and not stop yourself out in the wrong places. So if we look at the overall trend here, we see we've got a nice trend since the October low, just like all the other US equity markets. It is not taking out the August high yet, right? So if we put line up here representing the August high, we can see we're still beneath that. But we've at least made a higher low, and we've made a higher high relative to the November high. So we've certainly taken away a lot of the decline. But let's get into, how do you play with this now? Good rally, we sell off. Today's a day that has a large range, and this is real time right now. So we're, open and current price are kind of the same, lining up for a potential doji day, but we still have a few hours to go, so we can't tell yet. But let's kind of start now looking at what we've got. Well, I'd say most regularly, classically trained technicians are going to look at this horizontal line. Let me change the color of it so we can make it separate from what we just saw. So let's take kind of this teal colored line, or, greenish blue line, and say that this is just about the important inflection point. We had a high here in September. We came to it in November and faded. We came to it again in December and faded. We came close to it in mid-January and faded, and then we broke out above it, right? And then we come back to it and we're bouncing from it. And that's good. That potentially means we're going higher. And this is what most people would look at. Here's some other things that I add to the equation based upon how I look at charts. I'm going to put up propulsion. I'm going to put up sequential. I'm going to put up, let's look at a TDST line. Now, unrelated to this kind of green-blue line that we just drew, unrelated to that is the fact that over the last couple of days, there was this hyphenated purple line, which is the bearish propulsion level, meaning if we properly break beneath that, the targets move down to 179 and change. So if we break under 189, we're going to 179. The fact that it happened to line up with where this other place that most people look at, just to me, adds to the importance of this zone as being support, and makes me think that if, for instance, today we close beneath that level, so between now and the close of the day, it's midday in New York, so we still have half a trading day to go. If this sold off and closed under 189, and then tomorrow, let's say gap lower, that increases the odds that to me we're going down, and I'd have to stop myself out of a long if I had it on. If I put on a tactical long now, I can do that because I have this reference point here, and I can use a close underneath it to tell me to get out. So then I can at least have on a relatively low risk long trade with a defined sell stop. If I'm looking to be bearish coming off of the setup 9 count, which called the high in the middle of nowhere, not a place you'd necessarily think of that this move would have stopped, it's similar to how this bottomed on a setup 9 count back in September. So that also potentially gives us a near-term turning point. If I go back to the December lows, right after making the December low, our propulsion model told us that on a solid up move, again, this is now late December, Christmas week. This model already tells us if we get a decent up move, we can go to 197.75, and that is pretty much where this has topped out. So using a variety of models helps give me a much greater edge and helps me be able to deal with the market noise that exists because I have a process in which I trade by. It's not simply looking at a horizontal line and looking for a breakout the way a lot of technicians who will charge you for a subscription will tell you that they give you an edge in the market because we've broken out of a sideways pattern. By the time you get into this, you had a day and a half to 2 days to sell out, which you wouldn't have done because you wouldn't have known to do it. And now it's right back into where you got in or even lower than where you got in. That's the difference between having an edge and not, and why last week's video was about if you don't have an edge, you shouldn't be trading because you're going to lose money without an edge. And to me, your edge has to be far more than a horizontal breakout or a Fibonacci retracement. You need to have much better models because you are doing exactly what everybody else is doing, who has gone through basic technical analysis training and has essentially not created an edge in that space simply because they're doing what everybody else is doing. So compared to having no education at all in technical analysis, sure, it gives you an edge compared to not. But if you're just looking at the very common tools that most people who go on TV, most people who write newsletters claim they have, I will tell you that it is virtually no edge, and that you will consistently give up gains you had because they have no idea how to get you out of those gains in time, or you'll just simply lose because you will buy false breakouts and sell false breakdowns that don't actually end up being the way these people think. The amount of times that you have what appears to be, let's say, an upside breakout that then doesn't follow through is more often than breakouts that actually do follow through. So, and it's all about having a process. And, you know, would you simply have gotten long on, let's say, bar 7's close the day that this closed above the line? Would you wait for an additional day to see if it follows through? What happens if you bought the close and the next day you close back beneath the line? Would you have gotten out immediately? Would that be invalidated? These everyday technicians have no expertise, and most of them actually have no real professional trading experience to make the calls they do. They've learned the basics of technical analysis, and that's a good thing, but the odds are that over time you just can't really get ahead. And, you know, last week I had shown you, and if you haven't watched last week's video, please go into YouTube and watch it. I showed you the difference between information you get from the average person who writes a newsletter or talks on TV and what they think or their knowledge of really how one successfully trades versus the edge one gets when they really have far superior tools and a process behind how to use those tools in order to more effectively create proper risk reward trades. And that's really what I want to continue to drive home to you, is that shooting from the hip and just buying what appears to be a breakout is generally not good enough over time. You might make money on any given trade, but over time, you're not going to be ahead trading wise on these very simple elementary things that somebody says, oh, look, the trend line broke. It must mean the whole change. Just because the angle of a trend breaks doesn't mean that the trend has shifted. And I've seen several supposed expert technicians on TV telling you how to place certain things when a trend line breaks, and it breaks for 2 days, 3 days, because people listen to that person, adding more to the supposed breakdown or breakout, only to see the trend completely go in the way it had previously. So downtrends stay downtrends, uptrends stay uptrends. A trend line break is not necessarily enough to say that a whole trend has changed direction. All it does is tell you the angle has changed, not necessarily the trend. And this is what those who do very simple analysis generally get wrong, and do not give you an edge at all when it comes to trading. So that is what I wanted to say about that. Let it go back to this year, and now let's go through the XLC. And what I want to do actually is just start you off. Here's a chart of XLC divided by, the XLC, of course, is the Communication Services SPDR ETF, divided by the SPDR itself. So this is the sector divided by the market. And this is now, this XLC, this Communication Services sector, only came about in 2018. So it does not have a lot of historical price data, but I am showing you the all-time high and the lowest low it's traded, all captured in between January of 2021 and what went on last year. So one of the things that we see here when we look at this is obviously this had made a lower low in price from the May bottom here, which was only a short-term bottom. It made a lower low, but notice that the MACD made a higher low. All right, so I'm drawing an uptrend here and essentially a lower low against the lows here, suggesting what's called this is a bullish divergent bottom, not a negative one, but a bullish. So not bearish, bullish, because MACD made a higher high versus here, whereas price made a lower low. So that's one thing that potentially gives me a sense to start looking in this level. You'll know, for those of you who subscribe to my 7-Eleven report, you'll know that I put XLC back into the 7-Eleven portfolio on December 1st. So we essentially got long this right about in here. And we've had a good outperformance. Obviously, it's pulled back somewhat in January and into early February. I expect some support here from the conversion and baselines, and then an attempt up here to go and play with this dotted blue level over time. So I do think that I do like buying the pullback here and don't expect to test the lows, and do think that we can see some continued outperformance coming from what had been a very beaten down sector. So let's look at charts of the names that make up the sector, from the one that is most heavily weighted, which is Meta. So we'll start off with Meta. A few of these we looked at last week. So for instance, Google, we looked at last week when we did the top 10 S&P names last week as the stock review for the week. Here, let's look at Meta here. And you see for a couple of weeks now, we're stalling against the weekly cloud bottom. So far this week, today is only Tuesday. So right now we have an inside week, but we're still beneath this potential resistance from the cloud. If it pulled down into the, if Meta pulls back into, let's say, anywhere from 155 to 140 level, I'd probably think about buying it there. But right now we can make the case for why it is stalling where it is. If it does continue upside, then I have about a 212 target or so. And at that point, I probably look to take profits on the name for balance. At this point, I'd say you sell half. If you're long the name and you bought it at a lower price than where it's currently trading, to me, it makes perfect sense to be selling half into this 180-ish level. And then looking for potentially as high as near 212 on the other half. And I did this myself. I actually got long this name at the day it made its low last year, personally in my own account. I bought 100 shares and I sold 50 of them on the day that earnings were announced. What was that, a week ago? I guess 2 weeks ago, when the stock was up over 20% or something. I sold out at 188 and change. So I have sold half out myself, but these are kind of the parameters. I probably look to add down, into the mid 150s level or 140s. And if we get up at, like I say, somewhere near 212 or so, I probably kick out the rest of it. Google, the two Googles, GOOGL and GOOG, we looked at last week. So actually, for time reasons, I'll skip those. You can look at my assessments in last week's video. Let's move on to Verizon. And here's our weekly chart on this. And let's see what we have here. Well, we're certainly, this all bear market activity, rally to the cloud, rally just about to the cloud. Right now, we do have at least a higher high, higher low type situation, but we have not taken out any major high yet. The last major high was made in July. So all we did is we took out the November high, and that's not a bad thing. We've got a trend line here that currently comes in, I don't know, where's that kind of, let's call that 38 and a half-ish or so. We're only on an 11 count on this run, so it's not going to print a 13 without trading probably down to at least 37. I'll tell you, I don't have much to take on this other than, at least for now, when it's finally holding above its conversion line, which you see is at 39.57, and you could potentially use that as as long as we keep Friday closes above that, then I'll give a minor edge. But nothing that stands out to me that makes me immediately want to go and play the name. Let's look at Disney. So Disney double bottomed. The first of the two had a aggressive sequential downside exhaustion signal. We've come up, we've hit the cloud. You can see that not only we stalling, last week stalled against the cloud when, remember, Iger was all over the news last week, but also against 115.06, which is the bullish propulsion momentum level. So to me, this probably at this point has support down at about 101 and a half to, let's call it 98 and change. And here, not much to do. Upside breakout potentially gets you to the top of the cloud into the mid 130s over time. But if this keeps its count going, the 9 count up may very well be the near-term turning point in the next few weeks. All depends upon how this acts over the next 2 weeks and whether or not we sell off and kill this count, the current setup count, or not. But I'd look for some support into, as I say, 101 and change down to about 98. What do we have after Disney? Netflix. Netflix has just been edging higher. This one I've spoken about before. Again, last year I actually got long at 164 and change. I literally got long the day it made the low. In fact, it was back here in May that I got long. I will tell you, I kicked it out well too soon. I made nice money on it, but I missed a good amount of this rally. But when I look at this now, same type of thing, we've got an uptrend that it's well above, getting closer to targets just beneath 400, anywhere from 400 to what do we have here? 432. So let's say 398 to 432 is pretty significant resistance at this point. And if I was long and it got up there, I most likely would take profits, simply because also I look at this huge down candle that it had in January of 2022. That's where massive selling took place. I would not expect it to recoup that anytime soon. So if this gets another 10% to 15% rally, I would kick that out. And I'd be more inclined to be a buyer towards the bottom end of the cloud if it got there, and certainly, let's say, against the uptrend line. And here, I've got nothing to do per se if I don't currently have it on. Charter Communications, CHTR, bottomed on a set of 9 count, tested that in December. So the October low got tested in December. It is now stalling against 417 and change. You'll notice that that's the bullish propulsion level, similar to the S&P, where the S&P has stalled this week. And so this looks similar. So the strong move since December, support here, if you get the chance to pay 358, that's probably not a bad place to put some on. It's now just shy of 400, so nothing to do here. If we get a Friday close, especially if this Friday closes above 417, then to me, I could buy this and play for move at least up to the cloud. So you could get another 10% move to the upside there. T-Mobile, TMUS, certainly one of the best charts we've looked at, bottomed in January. How many things bottomed in January of 22? All right, that's pretty much where the whole world topped. This bottom then on a 13 count with the lagging line against the bottom of its cloud, and has been moving up steadily since, although, there's plenty of noise in here, but this is just made some new all-time highs. So if I have to assume that was all-time highs, yes, it was. So we have poked through, and again, there's plenty of people who tell you, oh, T-Mobile's on all-time highs, buy it. So you end up paying the new all-time high yourself, only to see, for instance, back here in December, a strong down week. That's painful. So in here, generally, there's some sense of an uptrend that's holding. I think I'd probably look at this or something just about that as your uptrend. So if this week or let's say next week turned around and closed beneath, where is this, 142.20, I'd be concerned that this could fall down to 130. But and notice here too, look at what the MACD is doing. So you made higher highs and you're making lower highs. So that's a negative divergence. I'm telling you that there isn't a thrust here. To me, you've got to get above 153 on Friday closes to then say this can get up to about 170. Otherwise, this is lots of noise that's going to catch most people in the wrong direction. Comcast. So here's the big sell-off. Let me just look. Yeah, that's from all-time highs. So this made all-time highs in, where's this, September of 21. Sells straight down and now has bounced, stalling right near the bottom of the cloud. Pulls back here. I'd look for support. If this pulls back here, I'd look for entry in between, let's say, 34 3/4 and 32 3/4. I'd be happy to buy there for another swing higher. And this already has a qualified and confirmed bullish propulsion momentum level, so it does target 43.5-ish or so. So in theory, you can be a buyer on pullbacks, especially if you're more aggressive, you pay around 37.5. If you're less aggressive, you wait for a pullback under 35. And the last name we'll take a look at is Telephone, AT&T. High yielding stock. The stock itself hasn't done much good for anybody in a long time. So let me just look at a pattern here and see. So when, let's see, here we have double bottom and double top. This then makes a new low, rallies back above what had been a double bottom, kind of in that neighborhoods. Let's see, kind of comes right to it. Then it breaks above, then it makes a new low. So this can be very choppy. And when you're finally convinced that there is a real trend, it's probably not. In this case, if you really like the name, and I'm not sure when earnings were, I think there might have been, I'm not sure. I'm just trying to remember if we've seen them this quarter or not, but and offhand, I don't know. I would check where earnings are, but right now you're kind of holding against the bottom of this very narrow cloud. It's not nearly a significant cloud when it's like this. If you want to buy the name, you could buy some here. Better to be a buyer in between 17.5 and 16.5 if the opportunity comes. And but certainly a general longer term downtrend that just want to look one last thing here before we wrap up is okay. So we just stalled here. Let me get rid of this line. So the rally that we did 2 weeks ago stalled against that downtrend line from the high in 2021, or that's actually the high of 2020. So this still is in a general downtrend, and it has not proven itself to the upside. You've got to get multiple Friday closes above 21 in order to really think that the game has changed here and that this is truly out of its downward pressure. So that is it for me for this week. I hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.